In this video, we're going to really delve into what they refer to as ratio analysis. So what are we going to look at? So we want to look at relative information. They look at relationships between different line items. And this sometimes is a little confusing for students. So let's kind of start with this. If I were to tell you that Walmart has $5 billion in sales and that Joe and Mary's general store down the street have $100,000 in sales, would you say that Walmart is a better company because of the amount of sales that it has? Would you say that since Walmart has $3 billion in cost of goods sold and Joe and Mary's general store only has $30,000 in cost of goods sold, would you say that they are better managers of their inventory? When you use absolute numbers, you really don't get a relationship that you can make comparisons to. This is why when you think of a ratio, you're thinking about a formula. It's a quotient, right? You're going to divide something by something else. The three categories we're going to look at are liquidity, profitability, and solvency. Liquidity talks about a company's ability to pay its short-term obligations. So we're going to be looking at short-term assets. Profitability. We want to look at the operating success of a company. I like to use the word control. How well does management control the expenses of the company? That now gives us a better reference when you think about comparisons. A bigger number means that company controls things better. Solvency. This measures the ability of a company to survive over a long period of time. Well, we want to think of this just a little bit differently though, right? When we're analyzing a company, we want to ask two general questions. Number one, how much debt does the company have? This is a measure of solvency. The more debt they have, the more likely they could have a problem. Not that they will have a problem, that they could have a problem. The other question we want to ask is, given the amount of debt that a company has, can they make payments, right? Can they handle the debt level that they currently have chosen? So we're going to work our way through these. And again, we've talked about the relationships, right? We can do this for the company intra comparisons. We look at industry averages, and we can look at competitors. So the collection of ratios that we look at, right, are here on the next several slides. And I don't want you to think that it's too complicated, but we're going to look at liquidity ratios. Here are the liquidity ratios that we're going to look at. And we'll talk about these individually as we go down the list. Now, again, one thing I will tell you is working capital, current assets minus current liabilities, this technically is not a ratio. It has to be a quotient because this is in absolute dollars. But it's going to give us an answer, right? It says, look, if your current assets are greater than your current liabilities, you'll be able to make all those payments. If that number is negative, then you have a problem. If you note down here, all of these relationships all involve some aspect of current assets. So we'll look at that as we go through them. Solvency ratios, we have three basic formulas that will look at solvency. Something called debt to asset ratio, times interest earned ratio, and the free cash flow ratio. And I will tell you that this is just a subset of the entire set of ratios for each one of these categories. For the profitability ratios, right? We have several of these. These come directly from the income statement, the gross profit margin, the profit margin itself. We're going to look at the relationship to assets, right? These up here, this price earnings ratio, we'll talk about that. That's a special kind of a ratio because it actually uses the market price per share. Again, we'll talk about all these in more detail. And again, here are some more what they refer to as profitability ratios. How well is the company controlling the outflows and the operations of the business? So how do we start this? We obviously need financial statements. Here's Chicago serial. We have 2021, 2022. That's the income statement. We then have the balance sheet. And again, I'm not going to get into detail here. This is obviously in a textbook. You can go back and review these line items as we go through the formulas. Now we have then a comprehensive statement of the cash flow statement. We might need, this might actually give us some answers to what's going on in the other ratios. So it's a very important statement to have these three statements to help us in this analysis. So let's start with liquidity ratios. And as we go through these ratios, I'm going to make some editorial comment as we go through. We've already talked about working capital, and I'm a little worried about the formula here, right? This formula is a little bit strange for me. The current ratio is just current assets divided by current liabilities. And again, if this number is positive, right? If working capital is positive, current assets are greater than current liabilities, the current ratio will be greater than 1. So again, greater than 1 is what we want. You know, it's best if it's greater than 2.0. But that really kind of depends on the industry, right? If an industry is typically an industry with low liquidity, then whatever that industry is, that's kind of what you're looking for as the benchmark. These ratios, inventory turnover and days in inventory, they really measure the same thing, right? They measure the exact same thing. They tell us the exact same thing. I prefer this days in inventory number because for me, it's easier to understand. Days in inventory tell us, on average, how many days is inventory on the shelf. The longer inventory is on the shelf means we haven't sold it, obviously, and that could be a problem. So we would like days in inventory to be smaller rather than bigger. Not too small, right? We don't want to run out of inventory, but we need to have a number that's not too big. Likewise, accounts receivable turnover and average collection period. They both talk about how we manage our accounts receivable customers. The average collection period, again, is a little bit easier for me. This one tells me, on average, how long does it take for my customers to pay me the money that they owe me? Again, as an accounts receivable person in a company, that's the number you want to know, right? You know, is this number too high? What do we have to do to reduce this number? Again, a lower number is better. Not always is it going to be 0, right? We're always going to have some accounts receivable. So let's see how we can account for these, right? How do we measure these? Here's the current assets for this company, right? Current assets divided by current liabilities. Here's 2022. Again, you can check these numbers out on those financial statements. In 2022, we were at 0.67, 0.60 in 2021. So what happened? There was an increase. That's good. when you compare our company to the competitor, we're the same. So we have equal amounts of liquidity. Neither one has a benefit over the other. But what we look at here is, look, the industry average is above 1, which again, that's where we want this to be. At the very least, we want it to be 1. So we need to look at this liquidity and ask why is this number so low, right? What's going on here? So again, the company can be considered technically insolvent, right? Now, they probably won't go bankrupt, but they could have problems in making payments if business slows down a little bit. The accounts receivable turnover number. Again, this just says on average, how many times per year does the company collect its receivables? And for me, that's difficult to envision what it means. Again, we want them to collect it more frequently than not, right? So 11.9, it's a decrease, a little bit of a decrease from last year, but we know what? It's less than General Mills, but it's greater than the industry average. So again, Giant Mills here has better accounts receivable turnover than what we do. So is there a better way to say that? Yeah, let's look at this. How many days does it take our customers to pay? If you look, you just take that accounts receivable turnover and divide it into 365. It converts it into a days number. On average, it takes us 30.7 days to get our payments. Giant Mills, 29.9. Well, you say, well, really, it's not even, it's just, not even a whole day. But think about this. If you did this every 30 days, right, that's 12 times a year. People are paying you. This is an accounts receivable. We talked about accounts receivable in an earlier video. Accounts receivable is an interest-free loan. So this means what? We're lending people money interest-free, and they're taking 30 days to pay it. 1 day more in Giant Mills. Well, what's 1 day? Well, if you're talking about $50, 1 day doesn't make much difference. But if you're talking about $150 million, 1 day of no interest is a lot of opportunity lost. And both are less than the industry average. So again, we need to look at these to try to understand more about how we're managing. In this case, it's how are we managing our accounts receivable. What about inventory? Again, here's the turnover, right? Again, the faster the turnover, it means less cash is tied up. So we're at 7.5. It's decreased a little from last year, but it's better than 7.4 and a lot better than 6.7. So our turnover is good. We're turning over inventory. We're selling it quicker. Again, for me, that's hard to understand. I like days inventory, days in inventory. How many days on average does stuff sit on the shelf? It went from 46 days to 48 days. So we slowed down. Why did that happen? But yet we are still what? We're less than this. We're less than the industry. So our turnover is better than our competitors, and it's better than the industry on average. Now it's decreased, which is going to concern me as a manager, but we're doing better than our competitors and the industry. So again, I like the days numbers because I feel it's much easier to explain, and it's easier for people to envision what's going on. So again, that's the end of this video. I look forward to talking to you about some more ratios in another video.